Welcome everyone to the Real Estate Experience Podcast. I trust you all are well and doing phenomenal and crushing it in 2020 through all of the moving parts and different things that have gone on. And today we will go into and also during this show, we interview highly successful entrepreneurs, investors in the industry to understand their mindset, their tools and tactics that they use that have ultimately gotten them to where they are. So we've got Kenny Wolfe here with Wolfe Investments, where he owns just over 4,000 units. That is in multiple markets, just to name a few, Texas as well as Ohio. And total valuation of transactions that he's completed is over 250 million. And just a fun fact about him, or something that many people don't know, is he was born overseas, or you grew up overseas?
Grew up overseas, yeah.
And a couple things, which one place was Egypt and also Australia as well. Doesn't have the accents. But maybe he does have the accent. But we'll go ahead and jump into things. Kenny, welcome to the show.
Thank you very much, Joel. I appreciate it.
Okay, perfect. And could you give the audience just your 5% ultimately of your pivotal moments that ultimately got you into real estate?
Sure, yeah. So I started out in oil and gas, as my father did, my grandfather did. So it was kind of what we did. So oil and gas was a way to kind of get going. And then really, oil and gas has major cycles. Everything has cycles, but nothing like oil and gas. It's either feast or famine, as we all are watching today. 16 barrel oil or negative $35 barrel oil, briefly. But so anyway, I was a CFO at 28 years old, started up oil and gas company, making good money for 3 years, and then my wife and I decided, hey, we got to get into something else, or I've got to go do something else, right? Because oil and gas is either highs and lows, right? And so what we did is we invested passively into multifamily, and so jumped straight from oil and gas to multifamily. So we skipped single family altogether.
Okay, and through that, I know there's a lot, of course, to unpack in that. So what was it that moment to where, I know you mentioned you had the volatility, but what was it that attracted you to multifamily?
It was like buying a business. So I was a numbers guy, right? So I can read an income statement and a balance sheet like no other. And then also too, you could use non-recourse financing. So those are two big key aspects to us. Well, I guess the third one, there's a lot of them, but third would be that you can afford on-site people to take care of the day-to-day operations at your business. Whereas you do single family or even small multifamily, you're part of the day-to-day operations.
Gotcha. And with that, did you have any limiting beliefs or anything when you made that jump, or you just, you were so, I'm trying to think what it is, but you just jump right in, committed. Yeah. How did that work?
It was a little crazy.
I was like, how do you just,
Yeah, our first syndication deal was 76 units. So we went from 0 to 76, and really it was just kind of networking, reading a lot of books and reaching out to folks. And then, and I saw other people starting at a 30 unit and how much they were dragged into the day to day. And it was like, the reason why I got into multifamily is the scalability, because you can scale it because of the non-recourse financing and the folks that can handle the day-to-day operations. So that's what we did. So we set our bar high. Hey, look, we want 60, 70 unit at a minimum.
So you were the main sponsor, the general partner on that first deal.
Oh,
or
absolutely.
You said pass. Oh, all right.
Yeah. And so we put under contract. I didn't know where I was going to raise the money because I didn't have it myself. It was one of those kind of leap of faith moments. There were probably 3 sleepless nights while I was trying to raise the money for that deal. You had 60 days to close it. That's with their financing and raising the money. So you're busy. But because I started out at that level, it's taken us, 10 times faster than what someone else that would have started with 32 units would have done. So.
Okay, understood. And how did so you committed first and then you ended up figuring the rest out later. And what was it from that very first experience that was your ultimate learning lesson that you're able to get from that you've applied to ongoing deals?
To me, it's easier to buy bigger. And I say that a lot to newbies starting out, but it really is, because you can raise, that on-site day-to-day staff is huge. They cut down your learning curve. Because I was coming from oil and gas. And so the management company that was running my 76 unit deal, I think at the time she had like 3 to 3,500 units under management right around us, or right in Dallas Fort Worth. And so, she knew the vendors to call, she knew the roofers to call, she knew all that side of it. And also too, like, this is kind of a bragging point, I guess, but I don't know how to evict anybody. And we've owned over 44,000 units. I don't know how to do that. I don't know how to change out a toilet. Absolutely not. So, I mean, it's those kind of things where you can, because we have great folks that work on our properties, and the day-to-day stuff, they're moving the ball down the field on the day-to-day level. I can focus on the bigger aspect, like build a portfolio, look at sales or refinances of our existing portfolio, how to unlock value.
Gotcha. So I'm just what I'm hearing, you already had that. I wonder if it was from books or you already had that frame of mindset to start scaling, to work on your business versus in your business. How did you get that? Were you just fine-tuned that way? Did you have a background in entrepreneurship?
So I always wanted to be my own boss. Ever since I was 16, I was very young. I wanted to be my own boss. So. But to do that, you've got to kind of, learn things. So for me, working at that small oil and gas company was phenomenal because I was employee like number 5, and then he blew up to like 200 employees at some point, kind of a year after I was there. So it was great because you're very hands-on. You learn all the accounting. You see how the wealthy treat their money and how they grow their business. And, he was a great guy and he worked hard, but it was mostly, us folks doing the day-to-day stuff. He can focus on the bigger picture. And so it's kind of a modeling thing.
Gotcha.
You want to model the folks you want to be like.
So you could say mentoring as you first started out?
Yeah, definitely. I mean, I was a part of, I joined one of those guru groups. I drank the Kool-Aid, and it doesn't work for everybody. I mean, I'd probably say 20-30% of those folks that join those guru groups and drink the Kool-Aid actually go and do something. Right. So you pay all the 20, 30, 40K, whatever it is these days. And then for us, for me, it worked because we bought a deal, right? If you buy a deal and it launches you, it's worth it. You spend all that money, you don't do anything with it. Well, it's pretty costly education. So it's, so definitely, I definitely had a mentor on the real estate side too, starting out. We did 2 passive investments before our first syndication deal to learn the ropes. So it was a lot of kind of learning and education. A little educational way to invest as well. So I wrote $100,000 check, my first passive investment, and my hand was shaking writing that, and because you're nervous, right? It's a big number, right? And so I'm 28 years old, 29 years old writing that
right
check.
now? Oh,
no, I'm 38, man. No, this is 10 years ago, but I was 28 writing that check, and it was nerve-wracking, right? But before I handed it over to the deal sponsor, I said, look, this is my investment. It's also my education. So I'm going to ask a lot of questions. I'm going to show up. If I can come on site and walk with you, due diligence or on-site tours, I would love to do that, right? So I made myself available. I asked a lot of questions. I wasn't annoying, I don't think, but he may tell you differently. But I wasn't annoying, I don't think. I respected his time, and it was a great learning experience to jump into a passive role.
And to dig a little bit deeper, let's say, what were 2 of the biggest things that you did learn from that experience? I know there was a multitude of things, but when you speak with people, what is your go-to that you normally say that you've gotten from that relationship that you just constantly repeat over and over?
I'd say there's 2 big learning points. One was that the biggest one, I guess, was our second passive deal was a Fannie Mae loan. And so because that was a Fannie Mae loan, my first syndication deal, we got a Fannie Mae loan just because of my experience, which was as a passive from that. So that got me into the Fannie Mae Country Club or whatever you want to call it, right?
Gotcha.
So, we got our first syndication deal, we got 81% leverage on a Fannie Mae loan on my first syndication deal. So, but I was only able to do that because I was a passive in that Fannie Mae loan. So that's a big key factor on that. And then also, I guess the second would be what I liked and what I didn't like about their asset management style. Right. So their reporting, all that kind of stuff. And then how they, they did some great things. They did some things. Oh, well, I would do this differently, so you can
Gotcha.
Model, but then tweak it to your own style.
Got it. Understood. Awesome. Well, the value of mentorship. And one thing for me, Kenny, when I first got started, I started the single family route. And the very first deal that I was able to get was with my mentor, who was the partner, and he funded the purchase price as well as the rehab. But in essence, my tuition and what I paid was my time, which I feel is more valuable than cash, with anyone's time, not just my time. And that's great that you mentioned that, and kudos to that. And so curious, in the past 5 years, what has been one belief, behavior, habit that you've that's most improved your life?
You know, it's a funny story. So, you know, that first deal, I was, that 76 unit syndication deal. I mean, I put it on a contract, you know, and then, the mentor at the time that I was coaching me said, well, look, if it's a good deal, the money will come. And that was really hard for me to sign that contract, that LOI. I mean, that was like, I mean, I'm putting my name on this and I've got money, earnest money at stake. I'm spending like 75K of my own money up front, you know.
Was it refundable, non-refundable, if you remember?
The earnest money was refundable up until after due diligence. So after due diligence, that 20 days, whatever it is, I think it was 21 days. You know, I had probably 75K, 100K heart, you know, basically.
And that's out of your pocket that you put down as the, yeah.
Absolutely. So, you know, so you kind of, so with that mentality that like, you know, once you kind of have to burn the boats every once in a while and just go for it, you know? And so we've kept doing that. I mean, not on 76 unit deals, but now, you know, now we're going for, we're buying a $20 million A-class deal here in Dallas right now. Right. And so we're trading up, we're going to bigger projects. And, so you can't be scared to try bigger things. You can't get complacent in your, you know, in your growth. So I guess that would be my biggest,
habit
that we've learned from and keep carrying it here in the office.
Gotcha. And you may not, and curious, what has been one limiting belief that you've had that you've replaced with a more empowering one? Is it that, yeah.
So, I mean, so we started out in multifamily and a lot of our, you know, investors and all that, they were trained on multifamily, or they knew us as a multifamily folks, right? Here at Wolfe Investments. And so, 2.5 years ago, we started to diversify in our real estate offerings. So we still do multifamily, but now we also do triple net and double net commercial properties. So dollar stores, we own 12 of them. Right now, and then we're doing
recession proof is what I've heard when it comes to those dollar stores.
And they print money. They're beautiful. They're boring, but they're beautiful. And then the third, we started our ground up development. And so I took on some townhomes across the street from our first syndication deal. I bought them myself, the townhome lots. I built these 6 townhomes that we're about to sell. And it was a way for me to be the guinea pig. You know, we didn't take any investors because I didn't know what the hell I was doing. And so and we're sell those, but now that's launched us. So now we're building an 88 unit ground up multifamily asset here in Dallas, Fort Worth. And so, not having the limited belief, like you only have to do multifamily. I think that's wrong. I think we still do that. We're still buying that A-class here in town. But you also, you know, to offer different things to your investors is something I've always wanted to do. And I think our investors appreciate it.
Got it. Understood. And I do want to go back to that point. It's now ringing in my head, the what your mentor said. You find a great deal and not the mentor, but the cash will come. Do you believe that's true?
I do believe that's true. Now.
Well, are you talking about in today's market, today's climate?
Yeah, I think so. I mean, we're, you know, we've got offerings. We're still raising money. I mean, people are coming over. You know, I think it's right now. I think it's foolish to sit on the sidelines. I mean, you can always find a deal. And the amount of stimulus that has been pumped into this country is more than double than what they did in 08, 09. The inflation is going to be real, guys. If you're not buying hard assets right now, between now and the next 6 months, because this is going to be a very short window, you're going to be left in the dark. I mean, I talked to another investor. He goes, "Yeah, this is 08, 09 again. We're going to like get all these good deals." I'm not seeing it, guys. Like on the operations front, you know, we collected worst property in our portfolio. We collected 90% of what we did in March. We already had people on our C-class in Cleveland, Ohio, prepaying May's rent.
Wow.
So for folks that think that people aren't paying rent, they aren't in New York and California. That's why we don't invest there. But to pick on those states a little bit, but in our states, you know, they're opening back up. Lenders are lending. It's not 08, 09 because lenders are lending, right? lenders are doing.
There's just more restrictions with some of the lending, but they're still lending.
You might not like it, but that doesn't matter.
Yeah, exactly.
We can complain, but they're still lending, right? I mean, so it's not 08 and 09. So to me, I don't think we're going to see these massive discounts on deals. I just don't see it on the existing multifamily space. But
and curious, between the next 6 to 12 months, because I've spoken with brokers to get their insights, and then also I go to direct to owners to buy deals too. So context on that is, do you feel there's just going to be a softening or just very low in terms of volume that's trading? Because sellers are, I mean, they're still kind of wanting top dollar. Maybe they'll come down a little bit, but also buyers in essence are, I mean, having to bring more equity to the table. So do you believe it'll shift more to the buyers, or there just won't be any trading at all?
I think there's not going to be any trading at all, and that's an overstatement. But it's going to be a lot less. I mean, it's because if you were stable pre-COVID-19, you're just hunkering down and going to ride out these next 3 to 4 months, whatever it is, and then back to square one. So we're back to full on growth mode because. And also too, something else that we're seeing on our operations is that we're still seeing traffic. Like our C+ deal in Shreveport, Louisiana, we took 13 leases last week.
Wow.
People are leasing. We're not having to cut rents. We're not having to do any of that. We're actually leasing the same amount of upgrade units in Columbus, Ohio right now that we were pre-COVID-19. So, I mean, people are willing not only just to lease our classic units, but our upgrade models too, which is just, to me, like, again, these folks that are sitting on the sidelines, like they're missing out, man. We've got a small window, you better take advantage of it now.
Yeah, and I still feel those people that are sitting on the sidelines, even when things get better, they'll find an excuse and say, oh, the market's going up and all this. There's all, that's how I feel about that. So going to more on the tactical side, how are you still finding deals in today's market?
So luckily we've been doing this for over 9 years. So we're a known buyer. So we get a lot of first cracks at deals. So like the past 2 years before COVID-19, we had, I think all of our deals, maybe for one, was off market. And by off market, I mean 4 or 5 of us saw it before it hit the open market. One was truly off market between seller and us. But but today, I actually hired an acquisitions guy 4 weeks ago because we are seeing some deal flow. They're all gross, ugly, not well-run machines, because that's what we're going to see a discount on. Again, because if you have a beautiful asset, why would you sell it right now? Just wait for 6 months, 9 months.
And where would you put that money?
Yeah, I mean, so why would you do it? So, I'm doing a deal tomorrow morning, actually, here in town, Dallas-Fort Worth. I actually looked at it years ago and had it under contract, funny enough, but the seller lied to me on that, on how occupied it was. That's a whole nother story. But so anyway, I'm going to go look at it. But these guys, these sellers basically just want us to take over the Freddie Mac loan. And they want their equity out for like $1 million or $1.2 million over that. Now, I don't know if I can do that. I got to go.
Is there a prepayment penalty or anything that's on that?
Yeah, that's why they don't want to. That's why they don't want me to assume the loan. But because we do a lot of Fannie and Freddie Mac work, loans. That's most of what we do. That we're pretty well known with Fannie and Freddie. They don't know me on a first name basis, but we've done a lot of turnaround properties for Fannie Mae. Like we're wrapping up a Fannie Mae loan. We assumed that seller's loan in Shreveport. We're now leasing it up. It was a horrible asset that they had on their books. We've cleaned it up. We put like $1.5 million into the CapEx on the deal. So it's a huge lift. And so they're now that they're seeing us, get it back to, stabilization, they're like, oh my gosh, thank you very much. And we've done that, I'd say 3 other times on where deals were, we weren't their initial deal sponsor, but the investors voted us in to turn those properties around and save those assets. So we've kind of made, we got that feather in our hat with Fannie. And so when we go to these assumption deals, it's pretty easy to get us approved on that assumption.
Okay, understood. I have not done a loan assumption deal and curious how the dynamics of that are. And so how are you attracting investors? What channels are you using? Is it podcasts? Is it referrals? How does that look from your side?
Right. Yeah. So it's right now because of COVID-19, we can't have our typical like in-person meeting. So we actually kicking it off tonight again. I've got from 6:30 to 7:30, we've got our monthly meetup. Usually we have that in person here in town. But because of COVID-19, we're having it online. So, which is kind of cool because I've got our guest speakers from New York City. He's a lender up there to kind of give us go pulse of the lending in the market. So we do that, a lot of podcasts, like this great one that I'm on now.
Yeah.
And then we do I do a weekly Q&A on Facebook Live as well. We've got a YouTube channel. So it's a lot of like social media outreach at the moment, just because we can't do those in-person events. But before COVID-19, we've got the MFIN conference that we do 3 times a year. In January, we had it in Houston. It was oversold. We sold out of like 400 people came to this event in Houston. It was packed. And so we bring in speakers from all over the country. There's breakout sessions. It's one day. So that way it's not like this multiple day, people can get back to their lives, but we had 400 people there. And then we usually hit up California. So we're going to go to San Francisco in June, but that's been canceled. And so we're looking at Boston again in October. So that's kind of our in-person meetings.
Okay, gotcha. And just one additional to that, how important do you believe personal branding is when it comes to attracting investors? Do you run everything through Kenny Wolfe, or do you run everything through Wolfe Investments?
We gotta have both, and so we have. So if you look on our Facebook, I mean, I've got a public figure page, which is more of that. If I go to visit a property, hey, it's me here at a property. This is what we're doing. But if we have like property specific updates, that goes through our Wolfe Investments page. So we kind of balance that out that way.
Okay, gotcha. Well, let's go ahead and shift to our rapid fire sharing round. Woo! So these will be some quick hitter questions. And the first one is, what is one unusual habit or unusual thing or absurd thing that you love to do?
Man, I mean, someone asked me that, what are my hobbies? My hobbies is the business, really. My family, we like to go hiking and camping, so we got a big trip out to Big Bend this January. It was awesome. Got to do, rent an RV for the first time, driving a 40-foot vehicle down West Texas roads. Oh my gosh. It was fun. But I was white knuckling it for, the day and a half to get there. So that's probably something that folks don't know about me. We like to go to the outdoors.
Okay. What is one common myth that you hear in the industry that you could debunk?
Start bigger. I mean, a 30-unit deal is like buying a boat. There's 2 good days. When you buy it and when you sell it, it's going to suck when you own it. I promise. I've seen it happen, right? I've seen people start out at that. And yes, you can start out at that level. That's fine. But the only thing holding you back from starting out with a property that can be professionally managed is how much money you can raise. So just go fix that. Go network more. I mean, I don't know what to tell people, but it's
figure it out.
It's easier to go bigger. I promise, guys. And it's going to really set you apart on your trajectory in a huge way.
Love it. And why do you see people in the industry? What's the common denominator in terms of why people fail?
Self-management, I think, is a big deal. That was 2 deals I had to rescue. We were voted in to turn those around, and the guy was trying to self-manage, and I think folks see that management fee and like, oh my gosh, I can make an extra, $2,000, $3,000, $4,000 a month, however big the property is, right? But what they don't realize is how much of a pain that is, unless you have the built out systems to have, 3,000 units underneath your belt. Then you can hire the right talent to run the day-to-day management company. So don't self-manage, guys. It's not worth it.
And Kenny, are you self-managing now at your scale, or are you still third party?
So we were about 2 years ago using third party, and then I got frustrated with that, so I bought one.
Okay.
So now we own 49% of Allied Property Management, and then actually we're about to acquire a management company up in Ohio too.
OH.
Yeah, so that'll take us about 12,000 units under management.
Oh yeah, people may say something about that in the comment section. So OH, and then the person on the other end says IO. Okay, there we go.
Hey, I've got 3 assets in Columbus, Ohio, so I've been to an Ohio State game, so I'm well trained on how to do that. So.
Fair enough. And last question is, why do you believe we're here on this earth?
I think we're here to do big things. I mean, I think a lot of folks don't give themselves enough credit. A lot of folks watch too much Netflix, and so design the life that they want. I mean, you can totally, if you're born in the United States, you're among the 1% on this planet. And you've got so much of opportunity to build a better life for you and your family. And you just got to turn off the TV, don't listen to the talking heads, and figure out what works for you and how to create those passive income streams. Because if you can create those passive income streams at a young age, here's a proud fact for you. So our daughter at the age of 10 bought her first single family rental.
What?
So if she can figure it out, you can figure it out. That's what I'm saying.
We've got to have her go to 75 units as the next.
Exactly. This morning I was walking out the door. She started looking for house number 2. So.
Wow. Love it. Yeah.
So you can do it. That's the point, is that if she can figure it out, and she didn't have the money to do it, she had some money saved up, but she didn't have the money to do it. You just got to network. And if you want to, you've got to figure out where you want to be. And if you can't get there today with your own means, then other people are willing to help you out. You just got to be able to offer them something in return. Value, right? So be valuable, show up, turn off Netflix for a little bit, to create your life. And then once you create that passive income streams, then you can watch Netflix or Star Wars or whatever you want to watch.
Whatever's going on. Yeah. So how can people find you, Kenny?
So the best way is to go to our website. So Wolfe with an E investments.com. We're all over social media, YouTube channel, Facebook, LinkedIn, all those places to find us as well. And
you do have a book too, correct?
We do, yeah. It's called Investing in the Dream. It's on Amazon. So it was a fun project to do. It's a very quick read, but it's a way to show people how I got started in the business, and hopefully they can model some of that, take some nuggets from there and model it and get going bigger, faster.
Awesome. Well, thanks so much for being on here, Kenny. And those of you who are on here, always appreciate, leave that like and subscribe to the channel on YouTube. And those of you who are on iTunes, whether you're in the shower, brushing your teeth, or listening to this while you're driving, would mean the world to me for you to leave that 5-star rating. So thanks so much for being on here, Kenny.
Thank you, Sterling. I appreciate it.
Thanks for listening to The Real Estate Experience. If this has brought you any value, please subscribe and leave a 5-star rating. It would mean the world to me. Now go out there and crush it.